don't have to swing at any of them. They may be wonderful pitches to swing at, but if you don't know enough, you don't have to swing. And you can sit there and watch thousands of pitches, and finally you get one right there where you want it, something that you understand, and then you swing.
Welcome to the Soya Investing Channel. My name is Colin, your retired average investor searching for above average returns. Today's topic is about my portfolio. Last video I told you the stocks I wish I never bought and the wish I held on. So now it's time to reveal the actual stocks I actually have. So let's get to it. First off, I want you to listen to this guy, Stan Druckenmiller. He's one of the guys that ran the Quantum Fund after George Soros. They've had a stellar record, but just give this a quick listen.
I'd say if you looked at our records, they're very comparable. When he ran Quantum and I ran Quantum, they're almost within decimal points. And I'd say George made more spectacular bets, and my record was a little more. The bets were more consistent, but the results were pretty much the same.
But do you agree with him in terms of that? You know, if you see an opportunity, just go all in.
Oh yeah, if there's one thing I learned from George and what made me a better money manager because of George, it's exactly that. It's not whether you're right or wrong. It's how much money you make when you're right and how much you lose when you're wrong.
So it's not a matter of whether you're right or wrong. It's about how much you bet when you're right and how much you lose when you're wrong. So I have about 17 positions in my portfolio, but it's concentrated in the top 6 positions. So my first biggest position is Meta Platforms, aka Facebook. I bought the stock, I bought the stock a long time ago when it was IPO'd, and I got it at 19, I mentioned, and I sold it around 30. And this is one of those things that's, again, sit on your ass investing. Would have made you a very rich man, but unfortunately I sold early. So I got back in 2018, around average price of 175-ish. Went all the way down to 134 or 2, and then it climbed up all the way up after the pandemic, over 300 something, and then just came crashing down since I had that slow growth earnings call last quarter. And now I've just averaged down. I bought more stocks, so this is one of my biggest positions. My average price is 202, and I do not plan on selling this for a long time. Okay. Why, you ask? Well, just look at it. First off, the PE is very reasonable. It's at 17. The stats on the company just looks like a Picasso painting. Revenue, very nice growth. Net income, very nice growth. The buybacks of the stock it's not increasing. The stock's not increasing. They're buying back stock. The return on equity is like very high. Profit margins, very nice, very high. And then the balance sheet, just look at it. Total assets here, 165 billion, okay? Has only 41 billion in debt, okay? Long-term debt is 0. Yes, you heard me, it's 0, okay? Cash on hand, look at that, close to 50 million. So that money, they can easily buy back more stock when it's depressed. Also, what it's doing, okay? Number 5 is Facebook, as far as the top websites. Number 7 is Instagram. This is where it doesn't get enough credit. Facebook Marketplace. It totally destroyed almost Craigslist and Kijiji. It's like the #1 place for selling used items. I use it for myself. And then you look at the digital spending, okay? It's only growing over time. Has a very good tailwind on this. And part of it is like, they have about over 20% market share. Google has #1, they have #2, and then Amazon's #3. And then they haven't even monetized WhatsApp yet. And they got over 2 billion users. Okay, so I see a lot of great things. And then also the metaverse. The Oculus app was the #1 downloaded app during Christmas time last year. It sold over 10 million units, which is equivalent to the Xbox. The MetaQuest store, where you can download the games and pay for the games, it already surpassed $1 billion. So I see a lot of great things for this company. And that's why we'll hold this for a while. My second big position is Fairfax Financial, traded on the TSX under FFH.TO. I bought this during the pandemic, and I was fortunate enough to get it at a really low price. Around 376 was my average, and I don't plan to sell this anytime soon because of this track record. Of course, past results does not equal future results, but it's a very good chance when you look at this. 35 years. Compounded rate of growth for the book value, 18%. Okay, even the stock price, compounded growth is close to 16%. And in the history, the book value that is higher than the stock prices. Only happened like 3 times based on the closing price. Okay, 1990, 1484. The stock price closed at 11. 2012, 378, closed around 358, again above its stock price. And then 2020, closing 478 is the book value, and at the end of 2020 it closed at 433. And I was again fortunate enough to get it at 376, and I do not plan to sell this stock. Reason is because of this man, Prem Watsa. We consider him the Warren Buffett of Canada. This guy's long-term focused. He even bought back 150 million shares during that downturn. And he even said at the annual meeting, he called this ridiculously cheap. 35 years since he began, he's never seen a bigger discount to intrinsic value. So this one's an easy soy investing, no-brainer, long-term. My third big position is Alphabet. I bought this stock when it was around, again, the shutdown at just under $1,100. And I'm still holding on to it, and I'll continue to hold on to it. Google is the monopoly in search, so obviously I'm just going to hold on to this for a long time. It has a very long runway. They own YouTube, which has over 2 billion active subscribers. It's going to stay on my stocks to hold for sure. Next one I have is Netflix. I've bought it around this price as well. And this company still run by the original CEO, Reed Hastings, and he's recently bought like $10 million worth of stock. Bill Ackman, a hedge fund manager at Pershing, also has about $1 billion worth of stock. And I believe this company is going to continue to grow. The P may seem very high at 35, but if you look at the history of it, it's actually quite low. I think the lowest was down here back in like 2011. But the P has always been high for this stock. The margins have slowly crept up and increasing over time. Netflix, I think, as far as content, for 12 months, it just needs 12 months of content. All right, so there's a certain amount of capex needed, but subscriber growth can grow as much as it wants. Right now, it has about 200 million subscribers. As that increases, the capex should plateau, and that's where more net income, more free cash flow will come to the bottom line, I think. The next one I have is Canada Goose. This is my fifth big holding. My average price on this one is around 32. If you look at the IPO, it was around 20-ish. And ever since then, it's gone up and down. Had problems with the shutdown and the pandemic, slowly recovering, but it's still, I consider, a really cheap stock. Some of the growth aspects of this company is China. It initially grew 85% in the second quarter and then 35% in the third quarter. Now there's a certain amount of shutdowns in China, but I think it will grow over time. And it has a footwear product that just started. Also, people seeing this right now is just mainly parkas, but it's also becoming a 4-season brand because it has a spring collection now. If later on it has a summer collection and a fall collection, definitely help the bottom line for sure. If you look at the presentation, you can see here in Asia it grew 31% growth year over year. In the States, it just has to recover a bit, and in Canada recovering, and also the direct. They were hoping for 70% direct to consumer, so meaning like just directly to internet. Right now it has 62% just through online sales. They've actually spent a lot of time just on PPE, helping out the government doing those PPE things. So that was at cost. So pretty much now they're going to just focus on business. And the last one I have is Alibaba. Okay, this stock I bought around average price 170. Yeah, I'm down on this one, but I believe this is a great company long term. I'm just going to continue to hold on this. If you look at the stats, the number of online shoppers in China will continue to increase over time. Okay, it has a strong middle class, and also they have an online cloud business, number 1 in China, and that will continue to grow. So it could be just like AWS, right? If you look at the top sites in China, Taobao, which is like eBay, which is Alibaba's company, right? That's ranked number 7. And then they have also 18% of Weibo, which is like their Twitter. They also have Tmall, which is like Amazon. And they have like 1688, which is also like their Alibaba B2B business. So if you want to order stuff and sell it from overseas, that's where you go to, right? And then there's also Alipay. The form of payment in China is usually either Alipay or WeChat. And Alibaba owns 30% of Alipay through Ant Corporation. And of course, the last one is Aliyun, their Ali Cloud business. And that's just some of the companies that they own. I didn't even mention ChowNow, which is their logistics company. This is an incredible business, and that one I'm just gonna hold. What I wish I did before, instead of buying it through the ADR, because people are always worried about delisting fears, which I don't think is gonna happen. But if I bought it on the Hong Kong Stock Exchange, that would de-risk everything, because I don't mind holding it for, like I said, long term. So that's why I have the 6 biggest positions in no particular order. If you want to see my other smaller positions, you can go to my website. I'll put it on the link below to show you my other companies that I'm holding. All right, so hope you enjoy this video. Hope you learned something, and I'll see you in the next video. Thank you for your time.